Hey, folks, welcome to Thursday Night Stock Charts Live. That means that there's one trading day left to go. It's almost Friday. Let's have a party. Thanks for being here. And what we're going to talk about tonight are our short-term bias. I was about to go down the dark, a rabbit hole of being bearish. I said, you know what? Let's not do that. I'm going to be plenty bearish tonight. Let's start off with being a little bit short-term positive. So let's do that. I'm going to give you my thesis, which has been the same since last Thursday. I'm bullish on the market, very, very short term. And you may be saying, wait a minute, whoa, 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 stop there, buddy. You're wrong. You're wrong. The market's down on the week. Yes, but we traded it. We went into the week short. We covered our shorts, went long when the markets were down, and we closed out those longs today. I think that we're going to bounce around here for the next couple of days. We'll talk about those trades in a moment. We're going to also talk about catalysts, folks. We're going to talk about incompetence, and we're going to talk about arrogance and hubris that is out there in this market. And we're going to walk through the indicators out there that the markets are sending us signals. And I've always said this, that the markets send you signals using technical analysis. You can either ignore them or you can whistle past the graveyard and unfortunately try to wither the storm that's a brewing. And you can argue that it is already here. The storm has already hit shore. We could argue that we're in the eye of the hurricane and we're about to get whipped with big, big winds, gusts. It's going to get ugly, really, really ugly. 2023 is setting up to be an absolute and utter disaster. So we're going to talk about the reasons why. I'm going to do bullet points, 1, 2, 3. So let's talk about and say hello first. Let's say hello to friends out there joining us with their precious time. Thank you for being here. Hit the like button. And how's my audio? Is it good? Franklin's usually on here to tell me how my audio is. It was Seymour Rivers. He bailed on us. Someday he'll be back. I will chide him for not being here to support the channel as our unofficial producer to ensure the quality of the audio, the video is of the highest caliber, streaming live from the studios here in New York. So let's say hello to our honored and our most esteemed fellows. Lewis, good evening, sir. RL, always good to hear from you, my friend. Tom, another week. Good to see you again. Mr. Pete, hey, Pete, welcome. RL, great audio. Thank you. Thank you. It's so nice to get acknowledged for having great audio. You know what's horrible is talking for a minute, minute and a half, which is like an hour in when you're live, and then you check the comments, and all of a sudden, hey Bob, no video or comments out there. Hey, somebody send him a text. There's no audio. So thank you. The audio is good. I'm feeling good. Thank you, everyone. Lewis, thank you. Bonnie Bean, where the heck have you been? We have very few females that come onto this show. We need a certain level of estrogen or else these mad lads take over the show and I can't deal with it. We need female presence, please. We got to calm these guys out. And McNeil, hey, brother, good to see you. All right, so let's get to it. Let's talk about our week so far. You'll remember from Thursday night, I was somewhat, we were positioned short. We went short last week of energy and of the S&P 500. And we booked profits. Oh, you're always watching. Okay, good. That's why it's somewhat tempered. All right. You're quiet. You're trolling. I get it. Thank you for saying hello. Let everybody know you're here. It keeps them humble. Keeps them on their toes. Plan to get SQQQ on December 13th as soon as the last, that's the short Qs. Okay. I would leg in, but I get where you're going. I would leg in. Okay, so we went into the week short and we did well. We did well with the shorts, but I anticipated that with the energy sector anyway, we were leaning into the third standard deviation Bollinger Band. I decided, you know what? We milked this thing enough. We were short up here. We covered down here. Today, no new daily lower low, intraday low. I do believe that this is still a very bearish candlestick today. I was looking for a rally back up to 88 to re-short, going out into maybe even April, even later in the year, because I don't know when it's going to dam's going to break. I have no clue. If I'm going to buy put options, I want to give myself plenty of time. And the longer you go out in duration, the less time decay that you have on that long position. And if you're selling premium and you're generating a lot of cash flow, well, that little bit of premium you're paying for your hedge is worth every penny because it pays for itself with your premium writing business. So we book profits here. I kind of wish I would have gotten short again on today's rally, but I would rather short into a resistance level. That didn't happen. So we'll look for another rally up here by the end of the year. Then we're going to look to lean in short yet again. S&P 500, we went into the week short of it. I I I didn't see a new daily lower low yesterday. So even though our momentum indicators, our Stokes in particular, are very, very bearish, trading down below 50, rallies tend to fade. I said, you know what? I'm expecting a rally here, so much so that I began buying heavily shorted stocks. I took a look at the ARK fund. It didn't have a huge short interest, so I took a look at their major components of the ETF, and it came up with Zoom. I was unaware that Zoom is the largest component of the ARK fund by far, and it had a multi-day short squeeze opportunity, and we bought it here. I was expecting a higher low, didn't happen. We were looking at a 30-minute chart here. You can see my annotations. We were expecting a rally here out of this downtrend channel. They washed it out, took it up, and we booked a profit today on Zoom to the long side. Now, I'm nervous about being long overnight, to be honest with you, especially with names that are right now not the most desirable. So I book profits if we get a little bit of more back and forth on Zoom, on ARK, which we bought also yesterday, and we sold that today. What did I do? Here it is. We sold that today. We booked profits on our shorts, on our longs, very small profits on the long trades, but decent profits on the short trades. And these are all directional bets. Uh, we're not ready to make big bear bets yet, but we will scalp trades at this point in time between now and the end of the year. Come the end of the year, any rally that we see in this market, we're going to be looking for excuses to short into, and we're going to go into the reasons why. But first, why might the markets continue to go up? We have fairly, this is the Bulls Bears ETF index, and you have a lot of bearishness here. We're not at the lows that we were at one point in time, but we have certainly come off those lows. But net, when you average this out going back to 2003, 2004, we certainly remain in the bear camp in the equities market, and for good reason. So when you take a look at seasonality, the week that we're in right now, let's just go with, oh, by the way, this is a call out for fellow member Larry. He gave me this trade today, TIPT, very overbought, bearish key reversal bar, RSI above 84. I would entertain shorting it. I didn't short it, but clearly we have a bearish reversal bar. This stock is probably going lower for a scalp. Longer term, it's probably going higher, but for a scalp, short term, it's going lower. Let's talk seasonality and why we believe that the market is probably going to continue up higher. Let's go with the cues. Wrong button, Bob. And the seasonality, as a reminder, we certainly don't want 2 years worth of data. Going back to, let's go a little bit more. You know what? This works fine. 13 years is good. All right, so here we are. This is not a good week. Seasonally, a poor week going back 13 years for the Trip Qs. It's only up 46% of the time. But as we move into the back half of the week, we'll be up on average 58% of the time next week. And then that final week of the year, it's a very, very favorable week out of the year for all of equity land because computers are on autopilot with a bias to the upside, very thin volume. You're going to see wide spreads between the bid and ask. The computers are trading 100 share lots, just keeping things going while the big bosses over at the Wall Street houses jump on their jets, heading over to Stad, Aspen, having a good time, skiing the slopes with their mistresses, having a great time, and they don't want the market crashing while they're doing their thing. So that's just the way of the world. So let's take a look now that we have our logic laid out for why we think the market is going up for the remainder of the year and what is the next year going to look at. First, let's talk about attitude. Let's talk about threats to the market. And the first up is this. And this is, I went on a tweet tirade this morning. I usually don't do that, but I woke up fresh and strong and ready to go. And this is what I tweeted out early this morning. This is the chart of the yield curve inversion relative to market drawdowns. For those not familiar with what a market drawdown is, basically it's a sell-off. It's a major, major sell-off in the market, not a minor correction, a drawdown, something that really puts a dent in your portfolio if you're not positioned correctly. So to have avoided the drawdowns in negative bear chart, mountain chart, I should say, versus the yield curve, when it gets inverted in red, you needed to be aware that the yield curve is inverted and that at some point in time, the Federal Reserve is going to have to pivot. And after that pivot, that's when things get real fast in the market because they're pivoting for a reason. What that reason is right now, we don't know. We have a clue. We know we're in a bubble. We know we have the bubble that's pricked somewhat, but we don't know what's caused the bubble to explode. What is that final straw that breaks the camel's back? Not quite sure, but God darn it, there are a host of other issues out there besides the debt crisis that could cause this market to head lower. And what I wrote here this morning, the best chart to share for a Christmas gift, we have been here before and it does not end well. Not an opinion, but historically factual, with a high probability equities having a poor outcome. It should be viewed as opportunity. If you're not viewing this as opportunity right now, you should be. When I come on here speaking bearishly, you shouldn't be looking at me and saying, oh, Christ, here's Chicken Little again, talking bearish, warning me about the sky is falling. Don't buy stocks. I'm not saying don't buy stocks. Buy the right stocks. Buy gold stocks. Buy stocks that are going to do well in a U.S. and global financial crisis. You want to be in those sectors that are going to do very, very well. Physical metals, those will do very, very well. So it's not about or short selling, as I wrote here. You know your environment. That's all I'm saying. Know your environment that you're in. I'm very, very optimistic about 2023 from my own perspective, because we know the history of how this all ends. It's right in front of you. I don't make this up. This is history. It's the foundation of technical analysis. It's the appreciation of past price actions and how they interact with current day price actions. And it helps you foretell the probability, not the definite outcome, but the probability of what will happen. There's no guarantee that what I'm saying right here, right now, is going to be the outcome in 2023. Maybe we're going to go 30% higher in the equities. I'll look like a goddamn fool. I'll be the first one to admit that it's possible, but it's highly unlikely. I'll put it to you that way. Now, I continued on with my Twitter tirade, and I ran across this one, and I wanted to play it for you. Let me play this aloud, because this just goes to familiar faces, and this brings me back to the financial crisis. Hey, another young lady along with Bonnie Bean joining us. She joins us. What's the phrase? What is it? Fashionably late. Fashionably late, but she's here. She's standing tall. Thank you, Jody, for being here. Always welcome. Great to have you. So these familiar faces, when I see this brings me back to 2000, 2001, when WorldCom, a huge, if you're not old enough to remember, a huge telecom behemoth, poof, gone overnight. Bernie Ebbers, handcuffs, perp walk, dies in jail. This guy was on CNBC once a month, every month at a minimum, treated like a god. Here you have Kevin O'Leary, Mr. Shark Tank, Mr. Wonderful himself. Here we go.
That was FTX money that you got. I don't even.
Sorry for the audio. This is what they must have recorded off the camera on the TV.
I don't think you should be singing the blues right now at all.
Oh yes, I'm singing blues.
Why? Because your 15 million didn't pan out. That's a lot of money to be a paid spokesperson. It's a lot of money. You didn't have to do much for that. That's found money.
That's a different decision. That's a different discussion.
Okay.
You can make that decision on your own, but
that was FTX money that you got. I don't think you.
Here's a guy that has the cachet enough, and this is why it matters. The cachet enough to be on Shark Tank, and for being on Shark Tank, it gives him enough credibility to get paid $15 million by FTX to come out and promote their product. $15 million. How many people did this guy lure into a trap? And he has the audacity to go on to separate interview, same interview with a different segment. It was too long to play it here. He said that he lost about $8 million on his investment. I believe it's $8 million. Fact check me on that. And his due diligence was, well, I was looking at the people that were investing, and they are very, very smart people. And he also said that Bankman-Fried was an American and one of the very few Americans that are in that business. This was his due diligence. FTX had no audited financials, zero. They have never had a board meeting, zero. I don't even know if they had a board. They certainly didn't have a CFO that was competent. So to come on here and to play the victim as he did on this interview, you got to watch the full thing. It's really mind-boggling. It just goes to show you these familiar faces use their cachet, and man, this is all one big, it's a big show, folks. And I have been around long enough, probably too long by now. It happens over and over and over again. You had Enron, WorldCom. You had all the big banks during the financial crisis. You had the government during COVID, and that's all coming out now. We can go on and on. And I tweeted this. I did a retweet, and this is a pretty popular guy, J.C. Parent. Let me tell you a little bit about J.C. Parent. I'm bringing him up not to bash him. I think that I follow him on Twitter. If I follow you on Twitter, that means I appreciate your work. All right, so let me put that out there. I think that JC, I met him, I think it was 2017 at the Chartered Market Technicians Symposium in Manhattan with the TrendSpider crew. And it was only a brief meeting, shake hands. And we were on in 2020. Oh, no, last year. We were on a symposium. We didn't tape our segments together, but we had, like, Sarah Strat had a session. He had a session. It was pre-recorded, and they combined it all together into one symposium, and it was a webinar. So we've had limited interaction, except for mostly on the Twitter sphere. And not that we interact all that much. I follow him. I don't think he follows me. That being said, he posted this out, and I don't know if he caught offense or what, but he was talking about crypto. I actually agreed with his comments here about crypto sideshow. Basically, if it goes to zero, all of crypto, it means nothing on the grand scale of the financial industry as a whole. And there's no argument there. There's zero argument for me. That was not why I retweeted his quote. the reason why I commented on this quote is that I'm not going to play this too long, too boring. Jamie Dimon is on here saying how uh, here's a guy who bashed Twitter years ago. Now he's got a whole, not Twitter, crypto years ago. Now he's got a whole division inside of JP Morgan Chase in the crypto business. That being said, he comes on here, bashes crypto because it enables drug deals, it enables trafficking, it enables all these horrible things that have been going on way before crypto, as if we get rid of crypto, we're going to get rid of all that. Give me a break. What Jamie Dimon is teeing up here, and this is my reply, or I retweeted this, sounds like Jamie is teeing up the Fed coin. The Fed coin, for those not familiar, is the CBDC, central bank digital currency. It's being tested now. Who's a part of the CBDC Fed coin trials? The big banks and MasterCard. It's already happening right here, right now. It's in trial phases. So I retweeted out, sounds like Jamie's teeing up Fed coin and wants to limit competition, meaning crypto. Because don't forget, and I'll go to the reason why in a moment, why they do not want cryptocurrency as a mainstream go-to, as a alternative to the US dollar. They're probably going to make it at some point in time down the road that you need to be an accredited investor. Wouldn't be shocked. Stay tuned for more on that. It is being tested right now. Once we go cashless, all the crimes he cites, which have been around for centuries, will thrive and expand to include our loss of individual freedoms. His reply to me, which I was surprised at, to be honest with you, dramatic much. And my reply to him was simple, and it took me about 2 seconds to retort. And it's what I've heard all my career. When I'm in situations like this where I'm screaming from the mountaintops, either A, it's a bottom, B, you got to get out. It's always the same deal. Chicken Little, whatever. All I'm doing is citing fact, and I just replied back. Funny, I hear that right before I'm right. And it happens over and over again. I say that with confidence. So again, this is no bash on JC Parent. I follow him. I would encourage you to follow him. He puts out really, really good content. So no bash there. So immediately after I replied to, this is the funniest thing. Immediately after I got done replying to JC, I go over to Zero Hedge. I start doing my morning reading. And what do I find? This is the second article in 2 days. Article headline. I'll link this out to you. So, yeah, let me throw this in there. Okay, I put it out there. So Nigeria, they went digital a couple of years ago, but nobody wanted it. Nobody trusts it. So, and rightly so. So they began a couple of days ago limiting the daily outflow of cash out of ATMs. Now they have a weekly max, and that if you want to withdraw more than the 5 to 10% max, you have to pay a 5 to 10% fee. Think about it. You're going to tell me that kind of money that I am being dramatic much? I don't think so. I think it's pragmatic. So this is the reality. It's already happening in Nigeria. They're already beginning to shut down, coerce people into adopting this digital currency that they don't want. They get no value. They only lose freedoms and pay more fees. Let's talk about, and this is the general attitude, that it's an apathy out there that is just shocking to me. It's shocking that smart people, JC is a smart guy, it's shocking to me that people aren't looking at the macro. You could be very, very good at looking at charts and saying, okay, we've hit resistance. We're seeing an inverse correlation. Now correlate, maybe we have to do something here. It's all well and good to identify patterns, but you need to put it into the context of what the macro picture is economically. And macro picture economically, it is an S show, family-friendly show, got to be clean, family-friendly show, but it is a S show. But to be honest, this week's economic data, and this goes to show you how sick and perverse the market is, the economic data that was received this week was not bad. Factory orders beat. What did the stock market do? Down. What happened? What are you worried about? Why aren't you rallying? Because good news is bad news. Anything that leads to the potential of the Federal Reserve not pivoting, as if that's going to save the stock market now, not pivoting, they have deluded themselves into ignoring history, ignoring what should be right in front of their face. That is this. This doesn't end well. Pivot does not end well. As a matter of fact, I have a better chart. Here are all the Fed pivots. Here's the yield curve in green, Fed's funds rate. They pivot, and the equity market. Oh, this is really not the chart I wanted. This is not the chart I wanted. Damn it. All right. Trust me. I'll come back to this on Sunday night. Join me. I'll have it up here for you. Every time the Fed pivots, equity markets implode. And I think that this is good enough. We'll go back to this. You see the inversion of the yield curve, just like back here, 2000, 2001, excuse me, the steepening of the yield curve. Here's the stock market behind it. Fast forward, financial crisis. What happened? Stock market dropped like a rock. Folks, we're back here again. Am I being dramatic? I don't think so. Look at this. This is history. This is the foundation of macroeconomic technical analysis. Let's take a look at the Federal Reserve's balance sheet this past week. They didn't do much. Not much happened here. It looks as though it was a pretty flat week. Very flat. So there's a bull case. We kind of went through this. What time do we have? I want to get some chart requests out there. I'm going to skip this. We already went over the bulls versus bears index, short-term bullish. We don't need to go through this. Skip it. We touched upon this. Skip it. Consumer discretionaries. So the consumer is in dire straits going into the new year. We're about to talk about what's going to underperform and the headlines that we're going to use as bullet points that could be the Achilles heel or the final straw that breaks the market back. And it could be a combination of multiple of things. So right now it's a focus on the consumer. Sip of water. So this is the XOY consumer discretionaries. They are a dead man walking. In a few weeks, you're going to have the 50-period moving average cross down below the 200-period moving average. I have the S&P 500 overlaid here in blue relative to the consumer discretionary names. They are dead. They are dead. They are not performing. And when they do perform, they underperform. So when you take a look at the new headlines coming out due to the already in system rate hikes, around 450,000 home buyers are now underwater. I haven't heard that on their loans. I haven't heard that since the financial crisis. Haven't heard it. And if you want to see what they did it again. They did it again. The delinquency rate at 6 months, folks, 6 months after loan origination. These are FHA loans. Here you go. Credit below 680, delinquencies ripping up higher. It gets less worse as a credit score improves, obviously, as you might imagine. But obviously, subprime yet again is a problem. I don't believe that this time around it's going to be as bad as people are making it out to be. The reason is that they're not making any more land. They're not doing it. And if you go to the digital dollar, if you see inflation continue to rise, they're not making any more land. Where do I want to put my money? In real estate. So while, yeah, the picture looks gloomy here, I think that 2023, 2024, you got to be looking for opportunities to get out there and buy up some opportunities, take advantage of situations. This is going to be one of my favorite areas as we move into the new trading year. And that is simply going out, buying the physical property, multifamily property. What else is going on with the consumer? Today, released today, continuing his jobless claims surge to 10-month highs. As you might imagine, California dumpster fire, New York dumpster fire of states, they are leading the way by far in job losses. Now you see Texas up there. Don't forget, Texas has been one of the largest job growers over the past several years. And now they're seeing a lot of layoffs down there. But California and New York, folks, I live in New York. I can't wait to get out. I can't wait to get out. It is New York City in particular is an absolute cesspool. More on the consumer. Credit card debt hits all-time high just as U.S. savings rate plummets to 17-year low. I'm going to take you back to this chart. Home delinquencies, mortgage delinquencies on the rise. Before I go back to that chart, let's continue on. This is the used car bubble. The bubble is imploding. The banks are going to get killed. They are repossessing cars hand over fist. What is 2023 going to be? What is 2024 going to be? Similar to real estate, it's going to be an opportunity I'm buying new cars. I'm buying new cars this year. I plan on it. I plan on being solvent. Therefore, I want to take advantage of these opportunities. So there are going to be deals upon deals out there on brand new cars. Brand new cars. People took loans with loan to value ratios of 140% of the value of the car. Great financial crisis. Remind you of that. So they're being repossessed hand over fist. If you're on YouTube, go over to Lucky Lopez. Check out his channel, Lucky Lopez. Very, very good channel. He will walk you through it. Now, we have delinquencies on the rise with mortgages. We have cars being repossessed. We have the consumer that is tapped out. We also have, I thought I had it up here, credit card debt ripping through the roof. But what's happening to wages? They're going down. And you may be saying, wait a minute, Bob. Whoa. I saw last week, the government reported that wages were up. They were up. How can you possibly come on here with a straight face, staring us in the camera with those doughy eyes? How could you say that wages are declining? The reason is that we're talking about real wages, estimated global real monthly wage growth, adjusted for inflation. Wages are not keeping up with inflation. Therefore, real wage growth, the operative word real, is negative. We're not using nominal, we're using real. And it's not looking good for the U.S. consumer, which is going to take me back to one of my favorite shorts going into the new trading year, which is going to be the XLY. And I only hope, I pray that they rally this ETF into the new year. I hope they short squeeze it, and I will be leaning into the short side like an animal going into the new year. So join us, 14-day free trial offer. What else do we have here? Oh, I want to do chart requests. So what are the other things out there that are threats to the consumer, to the economy. Well, you got to laugh. You have Bankman-Fried sitting in a Bohemian condo, walking around, having a good life, while multi-billions of dollars evaporated overnight. You have money that is tied to the Democratic National Committee. You have money that's also tied to Ukraine, tied to this guy. Why is he not in cuffs? Second largest donor to the DNC, you decide. But they could send all that money over to the Ukraine. But they must know about your Venmo payments. If you receive money or receivables in excess of $600, the 86 or 87,000 new IRS agents that are armed must know about it so they could keep track of you and tax you appropriately. Why are they doing that? Take a look at the receivables being received by the U.S. Treasury from the Federal Reserve. Bam, crashing. The Federal Reserve is not making money. Their receivables are dropping like a rock. They are not. Janet Yellen is so stupid. While yields were still near zero, she had a ton of cash from all these stimulus programs that were pumped up, sent over to the Treasury to send out to the people. She had all this cash on her books. And rather than say, you know what, Jesus, Mary, and Joseph, I know I just spoke with Jay Powell a couple of hours ago. He told me that, listen, Janet, wink, nod, we're going to be hiking in a couple of months. You know what? Do what you think is appropriate. That's your heads up. Rather than go out to the Treasury market and borrow at zero, she used the cash on her balance sheet and she drew it down. So she drew down the cash on her balance sheet while the dollar was rallying and rates were at zero. This nitwit is in charge of the Treasury. This nitwit was in charge of the Federal Reserve, which is one of the primary reasons as to why we're here now with a Fed balance sheet in excess of, I can't believe I'm saying this. Where are we now? Just below $8.6 trillion. To put things into context, we were at $800 billion in 2007, prior to the financial crisis. What is that, 1,000% increase? What else is out there? I simply can't believe my effing eyes when I see this. Sorry, family-friendly show. We are not... Hold on. I'm out of sequence here. Hold on, Bob. You're out of sequence here. Here. Out of sequence. U.S. secretly modified rocket launches from Ukraine to hinder strikes on Russia. Interesting. So what happened? What happened? Putin, risk of nuclear war rising. Why? Why would the risk of nuclear war be rising? Well, there were 3 separate attacks on nuclear-capable bombers 300 miles in the heart of Russia. Now, let's put that into perspective. I talked about this with members last night. You have a triad, a nuclear triad. We have it. The Russians have it. Submarine-based, air-based, and land-based nuclear weapons. We use stationary nuclear weapons and mobile. The Russians mostly use mobile. They have sub-based. They have air-based. We attacked, and I say we because we provided the Ukrainians with the weaponry to be able to do this. We are also providing the targeting, using our satellites to be able to target these bases deep within inside of Russia. We're not going to be able to give the Ukrainians the ability to target. We're going to keep that to control the war theater. So what we're doing right now is that we are poking a war, an escalated war that may go out of control. This is a primary concern for 2023. Think about if we have nuclear bases in Kansas, we have them in Idaho, we have them in Wyoming. Think about we had missiles striking those bases. What do you think that we would do? What if our Strategic Air Command up in Alaska had missiles thrown at them? What do you think we would do? There would be no response. And nobody's paying attention to this. More signs of slowing economic contraction. That's a double negative. Slowing global trade. I'll put it to you that way. A sign of global recession. Free falling China, Taiwan exports. We went over this kind of on Sunday night, but new chart, new data, and things continue to worsen up. We now have a Federal Reserve, and I'm so happy that they're doing this. I'm really, for the longest time, I was very disappointed in the Federal Reserve and that they were not as tolerant as they should be, not as considerate of diverse opinions. And I'm glad to see that they have really come around, and now we have a woke Federal Reserve. Federal Reserve unveils climate risk proposal for big banks for public comment. So what are they going to do? They govern the banks. They're going to cause the banks to go even further woke than they already are. BlackRock is woke as they come. So we have a Federal Reserve no longer focused on purely job growth, inflation. Now they're focused on what? Diversity. Apple, top iPhone supplier, issues demand warning. Morgan Stanley slashes handset production on estimates. I think Apple's going to be probably one of the worst underperformers of 2023 for many different reasons. They're moving their supply chain out of China. And I think this is probably the biggest problem that I have with 2023. And that is just the mask is off. I mean, the corruption, and this is just not a Democrat thing. This is a government thing. Republicans are dirty, not as dirty, but dirty. Dirty's dirty with their manipulation, their breaking of laws. They're breaking laws, the Civil Rights Act, the First Amendment. They have broken so many laws. It's been proven now that we live in a world that is, in New York, they don't enforce the laws. Many places in this country, they don't enforce the law. If you're not going to enforce the law, then you have no country. So how are you investable? So these things that are blowing up are all body blows. Picture the foundation of the United States, which has always been granite. But body blow after body blow to that foundation, shock, 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 and the cracks begin to build. And the question then becomes, what causes the break? And what causes new leadership to fill the vacuum that is currently empty? There's no leadership. There's just rot, there's corruption, and it's all for the world to see at this point. Now it's just a matter of, can we fix it? Is it too late? And I think what we need is really an economic cleansing, and it can be fixable. Here's consumer credit. This is what I skipped over. We don't need to go back into the yield curve. All right, so let's go over some charts here, and then we're going to log off. Then we're going to go to, go to stock chart requests. Just a few charts here. So, we've gone over the headlines of what's going to be the cause for the market to break in 2023. So what are the indicators that the markets are sending us? What are the charts telling us? Well, you take a look at the Fed funds rate. Let me go to some comments here. The lovely Jody, Ukrainians are very smart and they're great. Jody, I don't disagree with you. Ukrainian people are great people. my website, my engineering for my website, for anything that I do, my developers are in leave. They're great guys. I'm on Skype with them all the time, seeing how they're doing. So they're great people. I have a problem with the Western governments enabling the Ukrainian governments, and who suffers? It's the Ukrainian people. It's you. All this Zelensky had to do, all he had to do was say, listen, we promise not to join NATO. He had Russian tanks on his border. All he had to do was go out to the microphone. I promise not to join NATO. Okay, we're good. No war. He didn't do it. He didn't do it at our encouragement. And this is where the rot is. So no pox on the Ukrainians. Yes, they are smart. No doubt about it. I agree with you, Jody. Franklin, hey, brother. Bonnie Bean. They need to point them to the deep. Yeah, I hear you. Yep. There is a deep state. You could dislike Trump. He got it right. You got it, Pete. Remind me if I skip over it, okay? I got to. Where are you now, Jody? Smart move. Clark, where you want to? I'm looking at properties. I'm probably going to take another trip down through. I take a trip down through North Carolina, but really I'm focusing on Charleston, and I have family over in Tampa. So I'm looking at that St. Petersburg area. I'm looking for a dip in that market, and I'm looking to put on a multifamily property down there. I already got pre-qualified, so I'm ready to. I'm locked and loaded. I just need a deal to jump into. So yeah, I'm going to start shopping and get one leg out in New York when I want to. All right. So the Fed funds rate is at 3.78. All right. So what's the Fed funds rate? The Fed's funds rate, consider it like when you go to Target and you're going to buy a tube of toothpaste. Well, the store didn't pay the price you paid to put it on the shelf. They paid maybe 60 cents on the dollar of what you're going to pay. So they got 40% margins there, gross margins. Consider that the same deal as your Fed funds rate, right? So the banks go to the Federal Reserve, they borrow cheap and lend out expensive. Notice how while yields have been going up, the money that the banks have been paying on savings accounts haven't really kept up all that much at all. Different story. So the Fed funds rate is at 3.78. Yet the 10-year yield is yielding 3.491%, less than the Fed funds rate. That's the bond market saying if overnight discounted money is cheaper than 10-year money, excuse me, if you can get more premium on your overnight money versus 20-year lent out money, there's something 10-year money, very, very wrong with this market. That's the bond market saying nobody wants to lend out long. Everybody's afraid. They want to stay short term. They want to make quick profits, let those treasuries expire and go to cash, maybe reevaluate whether or not they want to lend long again. Everybody is afraid. So the bond market is the tail that wags the stock market dog. And right now, the bond market, which has rallied, is very, very sick. It's terminal. There's something very, very wrong out there. We could ignore it and whistle past the graveyard, hopefully, or we could acknowledge it, position right, and profit in the new trading year. The tip market, Treasury inflation protected yield. So you have The tip market, which investors go to for a safe haven against inflation, the Federal Reserve, they have been in a free fall, yet now they're rallying. What is that telling you? It's telling you that the tip market knows, the tip bond market knows, the Federal Reserve is going to pivot. They are going to pause on interest rates at some point in time in 2023. They're not going to stop right now. All expectations are for Fed rate hikes this week, or next week, I should say, of a half basis point. They'll probably do a quarter basis point, maybe a half basis point early next year. Maybe they'll drop down to a quarter percentage point and then stop. Once they stop, that's a pivot. And what the bond market or the tip market is saying right here, right now, is that, hey, we don't believe that inflation is dead. And if they pause, inflation is going to come surging back. And we want to have protection. So that is why you're seeing tips break out like you haven't seen them break out in quite some time. The dollar. While I don't believe that the dollar can't have a counter trend rally, and a very strong one at that, because let's face it, Europe and Japan are basket cases. The dollar is, for the most part, broken, and there's a lot of competition coming down the pike for the US dollar out of the BRIC nations. There are trial balloons getting floated out there because somehow or other, I don't know how the heck we did this, or the Europeans did this. They priced they capped the price of European oil, Russian oil, at $60 a barrel. How you do that, I have no idea when you're not producing it. So the trial balloon out there is that the Russians will say, fine, you want to play that game, we want to get paid in gold. Not just rubles, we want to get paid in gold. Why do they want to do that? The Russians and the Chinese are sitting on vast gold holdings. And if they get paid in gold, that means that governments have to go to the gold market, buy gold, then hand it over to the Russians. They have to take their cheap, filthy fiat money, which is worthless, go to the gold market, buy physical hard rock gold, which is only real money out there, and then deliver it to the doorsteps of the Russians. That will make gold go like this, the dollar go like this, and pretty much every major currency is going to have a seizure, because real money is coming back in vogue. That is the weapon that the Russians haven't unleashed in earnest on us yet. We have now bombed. When I say we, the Ukrainians have now bombed inside Russia. We have blown up the Nord Stream 1, Nord Stream 2 pipelines. We have, for all intents and purposes, declared war on Russia, yet we don't expect a counteroffensive. That's how arrogant we are. At some point in time, you can only push so far. Remember, for those that want to dismiss the Russians, they withstood the Nazi onslaught for 3 years. 3 years. They took apart their factories. They carried them over the Ural Mountains to the opposite side, to the west, or to the east of Russia. They reassembled those factories and built armaments, and then pushed the Germans back before we ever landed on D-Day. So to underestimate the Russians is a very, very stupid move. It's like ignoring the inverted yield curve. If you do it at your own peril. There will be blowback here, as sure as God made green little apples. I don't know what we're thinking. I'm not going to go over these charts right now. I want to go over some other ones. Now, here's our traditional chart of the yield curve. Again, folks, I talk about this constantly because we've only been in this situation only a few times in relative terms in history, maybe 12 times since 1955. Think about that. Since 1955, give me some room here. Fact check me if you want. Say 12 times since 1955. Every single time we have inverted, with the exception of one time in 1965, The U.S. economy has gone into recession. And ever since 2000, each recession has gotten subsequently worse. The only time we did not go into recession was 1965. Prior to the inversion of the yield curve, the economy was, think about this, was growing at 10%. By the time the yield curve began to steepen, we closed out the year with GDP of 0.01%. We just barely missed recession. Let's talk about gold. Monthly chart. Let's forget about the weekly chart. Monthly chart. Gold is clearly on the month an outperformer relative to basically twice as good as the S&P 500. Let's see where we're at on the year. S&P 500 down 15 spots, 6.1. Gold down 1.48%. The markets are sending us signals here. They want tangible assets, whether it be is it silver? Please use SLV. SLV. It's good. Silver is only down 1.39%. And you take a look at it on a monthly chart, up 3.82%, vastly outperforming S&P 500 and gold. The gold mining stocks. Monthly view, up 1.2%. You want to take a look at it on a yearly view. A rough year, but look at how far we've come off the lows, and we are still, despite being down on the year, outperforming the S&P 500, and for that matter, the best of breed stocks, the triple Qs, which are down 28.3% on the year. The last chart I want to go over is oil, and then we'll do some chart requests. You know, energy is everything. Everything is energy, meaning you cannot have an economy without energy. You have this numbskull out of the Biden administration today. He's speaking on camera in front of the White House saying they want zero carbon emissions by 2030 or 50%, something like that, some ridiculous number by 2030. They want to have like zero carbon emissions. Okay. So what are they doing? They subsidize solar panels out of Thailand and I believe Vietnam. What did the Chinese do? The Chinese exported their solar panels into Thailand and Vietnam to take advantage of the subsidies and then ship them over here. These are the numbskulls that we have in charge of this country. So the Russians invaded Ukraine back in February of this year. Well, I'm on a weekly chart. All right, that's right. I thought I was on a monthly chart. I'm saying, why are there so many months on this chart? Here's February. So let's say we were trading around $90 a barrel. We were actually higher than that. Look at where oil is now. Now, you could argue that we emptied the Strategic Petroleum Reserve, but that's done. And oil continues to break lower. Why? There's no demand. Demand is falling off of a cliff. You have semi-tractor sales, which are declining dramatically. Shipping rates are rolling over. In 2020, the cost of a container to ship goods was $20,000. Now they can't give them away. So these are all the signs that the charts are telling us, and there are a number of other ones. We only have limited time, that this economy is in free fall. And at some point in time, something's going to have to break here. And bear markets never, unless there's an event like COVID, they never just go down like that. They're at their all-time highs and just go straight down. It never happens. Rarely. COVID. But that was a shock. It's an event. It's a process. The markets see through. They're forward-looking. And this year, you could see that the markets have been, I'll put it to you this way. We've had the S&P 500 down 15% on the year, yet the VIX has never once gone above 40. Never once. Whereas back in the dot-com crisis, we were above 45. In COVID, we were above 85. Great financial crisis, we were 89. We didn't even go above 40 this year, and you had the S&P 500 down over 15%, Q's down over 28%. There hasn't been a washout yet, but it's coming. Let's do some chart requests. I can only take a few. I already FCX. Oh, FCX. You know what? I thought you were doing FTX, Sean. I thought you were goofing on me. Okay. Let's get to these. I know somebody asked for one first. The last one's going to be tonight. Is Baba for Falcon? Falcon, hello. Falcon's going to be the last one. I'm going to start from the first one, and I'm not going to leave anybody hanging that requested already. Thanks for being here. It's my honor to do these. So I know there was one way at the beginning. If I miss anybody, it's my apology. I'm trying not to. Beyond Meat. I think Carvana's going out of Falcon. Yeah, Carvana's going out of business. It's gone. It's dead money. Did they file? I know their creditors are lining up. They're banding together. Beyond Meat. I haven't looked at this chart in a while. I like the daily chart. I got to say that. Any idea what the short interest here is on Beyond Meat? This could be a short squeeze. 3-month sequential bottoming action. I like it. The shares have stopped going down. Hate the product. Weekly view, folks. We're using TrendSpider, automated trend lines, automated technical analysis, 35% discount code below. I got to come up with a better pitch. Weekly chart. Where are my fractal trend lines? We have a breakout on Beyond Meat. Good volume rising. We already have volume that's well above last week's volume, and it's above the moving average. Bullish. Inverted head and shoulders setup. Left shoulder, head, right shoulder. If we close above 1760, I'm not saying don't put on a couple of shares right now, but a close above 1760 would probably set us up for a short squeeze. My bet is that there are a lot of shorts in this name. So Beyond Meat, hate the company, like the chart, bullish. We broke out of a downtrend channel, a large one, multi-month downtrend, consolidating gains here, attempting to break out. I think that you could nibble on these shares, small, scratch the itch, get it out of the way, so that way you're not chomping at the bit to go jumping all in. I'd be a buyer on shares above a close above 226 and then the subsequent close above 237 per share. That's life. Bullish. I don't like this stock. Prethemis Biosciences overbought. Sell it. I would get out. You're trading above the 3 standard deviation Bollinger Band. In short, you're not supposed to be there. I would get out. If you have profits, make them real. My own opinion. Consult your financial advisor. Same deal here. Trading above the 3rd standard deviation Bollinger Band. I'm not saying it can't go higher. Probably will, but I would not enter this trade. I would not try to short this. You probably couldn't get the shares if you wanted to. But if you wanted to buy them, wait for a pullback down to 10 bucks a share. Pete, you're the one I was looking for. Momentum Holdings. Bullish. Bouncing off the lower band of the declining downtrend channel. Bullish key reversal bar. No new weekly lows. Good for a trade. Stop loss right below the lows of the week. I think you trade it up to the upper band of resistance. For those not familiar with automated trend lines, watch this. Now you see them. Now you don't. That's the trade. Here, click of a button. 35% discount code below. If you're not using this, you're wasting time and you're losing opportunity. Rally up to the upper band of resistance at around 65 bucks a share. I'm going to write this one down myself. Light. I'll remember it. Light. As a matter of fact, I'm going to make an alert here, and I'll add it to my alert list. If they sell options, I'm going to sell some premium here. Again, bullish, stop loss right below the lows of the week. We broke out today above the upper band of resistance. Looking good here. I like this stock moving up. Beyond Meat, we already did. This is for Falcon. Plug. No. Head and shoulders set up. Left shoulder. Head, right shoulder. We're currently below the neckline of that head and shoulders setup. If it rallies tomorrow, I would revisit it. But right now on a daily chart, it's not looking good because we had broken out several days ago. We have now broken back down into this downtrend channel. That's a breakout point failure. Unless it gaps up tomorrow off the table, I would avoid it. LEU. Centris. Avoid it. Avoid it. It's broken down. It's broken. Avoid it. It's going lower. It broke down below the lower band of support. It's broken down below its VWAP. No interest in this position. It broke down on the 6th. It's rallied back in an effort to recapture support. I would avoid this. I think this is a dead cat bounce. I think it breaks to go lower. Oh, Jody, you moved up to New England. Good for you. Pretty up there. Freeport McMoran, I happen to be bullish on the stock. Down week so far this week, but a lot of these stocks are, material stocks are down. I like the setup here, consolidating gains over the past several weeks. I think that this stock is going to break out higher. Remember, we're going into an environment that whatever you drop on your foot and it hurts has value, okay? Paper is not going to have value unless you could drop it on your foot and it hurts you. Paper money is not going to have value. Stock certificates, unless you're in good sectors, aren't going to help you any. You want things that are tangible, especially when we get the digital dollar out. So FCX, I think, is going up higher. Last one up is Baba. 4. My main Caballero. Falcon, Bob. Only for entertainment purposes. Looking at Baba daily chart. All right, let's bring it up. I'll look at what you're looking at. All right. How do you enter the trade? Just grab your just grab your phones and jump in. In this situation here, you probably could. All right, first off, I got my disclaimer. I do not invest in Chinese stocks. I just don't do it for many different reasons. So we have broken out above this downtrend channel. We have done somewhat of a pullback and a retest. I think you could nibble here. I wouldn't, because it's a Chinese stock, and Jack Ma's not around anymore. Oh, this is a weekly chart. You want me to go over the daily chart. So the weekly chart, you have a breakout. You also have a continuation breakout. Sorry about that. Daily chart. You have resistance immediately above here, Falcon. So be careful. You're going to have resistance at around 95 bucks a share. Then above that, again, with a 95 handle. So you have some stiff resistance overhead. So I would not be a buyer here. There's just not enough reward for the risk that you want to put on right now. If you want to get long of the trade, I would do this. Like the trend, you could use the automated trend line here. This will probably be good. Waiting for the lower band of support to get tapped. This is rising, so I can't get a number of when we'll pull back to that, but we will pull back to that at some point in time. That doesn't mean that we're not going higher first, but another way to leg into the trade is, I did this terribly. Wait for a pullback to around 89 bucks a share. Stay small, because if that breaks, you're coming down here to this lower band of support. Let's call this right now the midpoint. And that's what I would do. I would not buy right here, right now. You have way too much overhead supply. You're going to take on way too much risk. You're not going to get paid unless, of course, we break out through 2 stiff resistance levels. Heck, which we may. I don't know. I'm not that smart. But all we want to do is we want to focus on our probabilities of profit, right? How do we make sure that each trade delivers, prior to us going in, the highest probability of profit? It's simple. We wait for the retrace to a support level, we nibble. Then as we rally and we break through resistance, we add more. That's how we increase our probability of profit. All right, folks. With that, everybody have a awesome trading night. Thank you for being here. Profitable trading day to you, and have an awesome weekend. And don't forget, Fed meeting next week. It's going to be a volatile week, but after the Fed meeting and after CPI, which comes out on Tuesday, the year is over. You're probably going to see a drift up higher, and then I'll see you in January. So be careful. Don't take on large positions. Just be very, very careful. And don't chase the morning rallies, folks. They want you to do that so that the way they could sell into you. So please be careful out there. We're in dangerous waters. Be well. Have an awesome night. Thank you for being here. Take care.